When we talk about bonds, we usually think of a simple seesaw. When interest rates go up, bond prices go down. But in reality, it's not a straight line. It's a curve. This curve is what we call the convexity effect. Essentially, it's a mathematical bonus for investors. Because of the way the math works, a bond's price will actually rise faster when rates fall than it will drop when rates rise by that same amount. This extra cushioning makes the bond more valuable than a simple linear model would suggest. To understand why this happens, we look at Jensen's inequality. In bond pricing, the formula is 1 divided by 1 plus the rate. Because this is a convex function, the math proves that the average of the prices is always greater than the price of the average rate. Mathematically, we express it as the expectation of the price being greater than the price of the expected rate. This little greater than sign is the secret to convexity. It tells us that in a world where interest rates fluctuate, the bond is worth more than if the rate just stayed perfectly still at the average. Let's put some numbers to it. Imagine a $1 bond where there's a 50-50 chance the rate will be either 4% or 12%. The average rate is 8%. If we calculate the price at 4% and 12% separately and then average them, we get about 92.7 cents. But if we simply calculate the price using the average 8% rate, we get only 92.6 cents. That tiny difference, that extra fraction of a cent, is the convexity effect in action. The market recognizes this extra value, which is why actual bond prices are slightly higher than a basic average would predict. Now, time is a major multiplier here. The longer a bond has until it matures, the more curved its price-yield relationship becomes. Think of it like a piece of flexible wood. The longer the piece, the more you can bend it. For a short-term bond, the convexity effect is tiny. But for a long-term bond, the compounding effect of those interest rates makes the curve much steeper. This means that, all else being equal, the longer the maturity, the more valuable the convexity becomes to the investor. Volatility is the fuel that powers convexity. If interest rates are stable and barely move, the curve doesn't matter much because you stay on one spot of the line. But if rates are volatile, swinging wildly between high and low extremes, that curve becomes your best friend. The more rates fluctuate, the more that upward push in price benefits you. This is why we say the value of convexity increases right along with market volatility. Finally, how does this affect your bottom line? Because convexity adds value, investors are actually willing to accept a slightly lower interest rate or yield for bonds that have it. If a bond is highly convex, its yield might be a few basis points lower than you'd expect. In short, convexity lowers bond yields because the price bonus it provides acts as a form of protection. You're paying for that curve by accepting a slightly lower yield, knowing your price is better protected against rate spikes.